Hello. In these next few videos, we're going to look at the problem of bond portfolio management. So we're going to put ourselves in the shoes of a financial institution, like a mutual fund or a hedge fund or an insurance company or a bank that may have a portfolio of bonds. So as we know, bond prices are sensitive to interest rates. If interest rates go up, bond prices go down, and vice versa. So there is interest rate risk. Okay? So our first job will be to come up with a measure of interest rate risk. That is a measure of the sensitivity of bond prices to changes in interest rates. Okay? Then once we have that measure, we will see how to apply it to develop several strategies to manage bond portfolios. Okay, so let's start. I'm going to open here a link that you can also find in the handouts. So what you see here on the left is the term structure of interest rates for the US market. And this site is very nice because you can see how the curve was at different points in time. So here on the right, this figure here on the right is actually the stock market, the S&P 500, as it goes up and down from around the year 2000 until today. Okay, but what's really cool here is that you can make this move. All right, so time is moving forward, and here on the left we can see the yield curve varying from day to day, right? So again, what we want to do is we want to develop a measure of interest rate risk. So in other words, I want to describe how this curve varies through time. Okay. So this is a complicated problem because I am not just trying to describe how a single point in this curve varies. What I really want is to describe how the whole curve varies. So how this set of rates for all these maturities varies from day to day. Okay, so I want to do this in a useful way. That is, I want to come up with some measure that describes in a simple way as much as possible of the variation in this big set of rates, in this whole curve. Okay. So I want to try to look at this variation from day to day and find one simple way of describing it. And maybe it will help to put here a little bit of a lag. So you can see now these gray lines showing the curve in the previous days. So you can actually see clearly how it varies from day to day. So if I want to find something that describes as much as possible of this variation in a single number, what I find is that, and here you can see it clearly happening, most of the variation from day to day is a level variation, meaning from day to day you see a change that is more or less the same across all maturities. Just a small change, just a little bit, but more or less the same across all maturities. Okay, from day to day. Then over long periods of time you see what is just happening now, which is you also see a change in the slope. The curve was flat and then it became upward sloping, and then you also see some of these changes in curvature as it's happening right now. Okay, but that's over longer horizon. So most of the variation from day to day is really just this vibration, this level change. Okay. So let's move on to the handouts. Here. So again, what we concluded from observing what happens in reality is that over short periods of time, all yield curves move up and down roughly together. In other words, we see these small parallel shifts in the curve, right? So we want to develop a measure that captures this small parallel, or that captures the sensitivity of the bond price to these types of changes in the curve, right? So what we can do is the following. We can decompose the term structure as we see it into two parts. One is a constant part, and the other part is what's left. So if we go back to that figure here, basically what I'm saying is that I can pick a point in the curve. Let's say it's this point here where the curve starts, and I can think of a flat line here going through that point. So this would be a constant level r, okay? And then what is left would be just the difference from that constant number to the actual value of the curve on that day, right? Okay, and now the question is, if I want a mathematical object that captures the sensitivity of something with respect to some other variable, that mathematical object is a derivative, right? So what we are going to do is we're going to compute the derivative of the bond price with respect to interest rates. What we mean exactly here by interest rates, we mean that part, that constant level in the curve. So if that part changes, the whole curve changes by a parallel, in a parallel way, by a constant amount, right? So that's the main measure of the sensitivity of the bond price with respect to interest rates, the derivative, as usual, okay? Then for reasons just for convenience and for historical reasons, we do this part here. So we put a minus in front such that the derivative actually becomes a positive number. And then we divide by price just for convenience. Okay, but this part here really has no important economic meaning. What is important is really the derivative concept. Okay? In some books this is called modified duration, but in here we will just call it duration. All right?